holidays. We're going to start with cotton, and there's uh, there's where prices have been for the last year and a half. If you go back right and just short of the middle of the screen, it's a year ago, and you can see that we've been in a sideways band between about 78 and 88 cents roughly, with a few little dips to the outside of that range. But we're range bound and we continue to be range bound. And as of this morning, the March futures were a little bit under 80 cents. If we look at the supply and demand, the latest numbers that we have to work with, that report came out a week ago, and it wasn't very surprising. It didn't do much, but it did kind of tighten up the picture. No, not tighten it up. It made it a little bit heavier. I would describe it as a modestly bearish report, in that um, they cut production, but U.S. production, they cut U.S. production, but they keep whittling away at domestic spending in the U.S. and more importantly, they've been cutting for like the last 3 or 4 months straight. They've been cutting domestic mill use in important places of the world like China and India and Vietnam and Thailand and Indonesia, places where it counts. They've been cutting domestic spending in the major importing countries, and that's kind of a sign that the industry, the market sort of anticipates weak demand, and that's been the story. That's why prices can't seem to rally, and they stay stuck in the trading range, that they're in. So the numbers, the adjustments they made in December. If you look at the world numbers particularly, they were modestly bearish. Here in the U.S., they actually trimmed the bottom line 100,000 bales, but that I'd just call that a neutral adjustment and a neutral outcome. So, and I don't think there's very many surprises left, uh, related to the 23 crop. We've gotten all the standard data in the previous supply and demand reports, and now ginning, by all accounts, is kind of wrapping up. Some of y'all may be able to tell me differently if you're in the high plains or the rolling plains and your local gin is still cranking, but I'm hearing stories of gins wrapping up, which seems to me to be somewhat early, but we didn't really have that big of a crop or that late of a crop. So anyway, ginning is wrapping up, and when they've counted the last bales and classed the last bales, that may be a month from now, 2 months from now, but I think we're closing in on the final number, and they'll reconcile classing and ginned data. They'll reconcile all that with their current estimate of the crop size, and then we'll have our final estimate, and that's pretty typical of the time of the year. If you look over here in the middle of the chart, this is January, this is February, and usually USDA's guesstimate of the crop size in January and February is pretty close percentage wise to whatever the final number was that year. So this is just a picture of history that shows that by midwinter they generally figure it out, and by May they've always figured it out. So we're zeroing in on the number, and all that means from a marketing standpoint is that there's few surprises left, uh, about the 23 crop and the size of the crop. There's few supply surprises left, and so that's not what's going to pull up on the market. And I really don't think demand is going to pull up on the market, because of the implications for weak mill use. And our export sales, we've had a few weeks of good export sales, but we've had a whole bunch of weeks of crappy export sales. Even at low prices, we ought to be selling more, but we're not, because Brazil is undercutting us and outcompeting us at the moment. So we may not sell for another, it may be February, March, or April before U.S. export sales kind of pick up. So again, I'm not really seeing much pulling up on the market, either from the supply side or the demand side. And the fears, I'll call it recessionary risk, the uncertainty of whether we're going to slip into a recession or whether we'll just have slow growth, and what the effect of the maintaining the high interest rates. We've had a little bit of progress on the inflation side. This blue line is the inflation rate. This is back when we didn't have inflation. This is back when we were really scared and it was at 9%. And we've dropped down to about 3, which is good. That's progress, but the target rate is 2. So they're going to probably just keep on with the interest rate hikes that they've done, and those are a drag on the economy. So again, all of this is sort of, it doesn't speak well for having a strong booming economy. So I don't see the demand side really pulling up on the market. So that just kind of leaves us range bound again. The supply influence is pretty much done, and the demand influence is not really strong. So I think we're stuck in a sideways market. If it rallies up over 80, if it rallies to 84, 85, there's going to be a whole bunch of selling by the folks that still have unsold bales sitting in a warehouse. They're going to jump on that. That selling pressure right there will keep us range bound on the upper end. But I wouldn't tell anybody not to sell. I think if we do rally back up into the mid 80s, that's probably the best shot that's left. So I would take it if it was me. And the focus is now shifting, of course, to next year. And with the moisture that we've had and that we may continue to have, if we plant 10.5 million acres, we could have 15.5 million bales or better. And if that happens with this uncertain demand, that may weaken prices further. That may weaken prices down into the low 70s or down to 70. We haven't been there in 3 years, so I'm kind of worried. I'm kind of worried about that, but we'll have to see how that unfolds. And that wraps it up, Poncho. So I will end my slideshow.
Excellent. Thank you, John. Any questions for John? John, if you can stop sharing, I will start sharing mine. Excellent. Thanks. Okay, can you all see mine now? Can you all see my slides?
Yes.
Okay, perfect. So today I'm planning to talk a little bit about wheat prices, wheat market, but also, I'm trying to update, the budgets for next year. So I'm going to show you that, show you what, are the prices and how are the margins for next year. What are we expecting with these prices? Okay. So the first thing, this is from USDA ERS, in September. And basically this shows, what is the farm net income in the US. Of course, in 2022, we have, probably the record high. And for 2023, those net income went down. And especially, in 2024, we still think, they're going to go a little lower. Basically, what we have, higher income farm receipts were much higher. We had much better prices in 2022. Okay. We did have a little government payments, but mostly was, the much better prices, on production. Our expenses has been increasing. Okay. So now we are facing a little lower income with, higher expenses. Even those expenses, we can, fertilizer prices have gone a little down. Another input might go a little down, but overall, they are still, higher than what we had, 3-4 years ago. So this is a little bit the story of what happened with, corn, sorghum, and wheat, cash prices here in Texas. So about 3 years and a half, July 2020, we have wheat prices, 386, okay? Those prices start going up because of drought, weather related. Then Russia invades Ukraine. How 2022, those prices jump. We got the high prices of 12.62. Okay, so from 386, we went to 12. But remember, before Russia invade Ukraine, we have a price about $8. Okay, and after that, those prices now start going down, and we have now a price of 583. And we're going to see that even with this 583, when we look at world stocks, we are still more in terms of how much our worldwide ending stocks are, they are lower than what we have in 2022. In terms of US wheat use, this was done with WASDE, on the last WASDE. We see food and seed wheat price, wheat consumption hasn't changed that much. Probably these last 20-25 years, we haven't seen a big change on that. In terms of exports, we had the lowest exports last year. That's mostly because in the US, when we try to compete because of the drought here, the wheat prices here were much higher than, in most parts around the world. Okay. And we've seen those ending stocks 22, 23, where we were low, and we are expecting 23, 24 to have those ending stocks a little bit higher. Let's talk a little about what weather, what we're expecting. Okay, so we all know when we heard about that we are in the Nino. Okay, we are probably in a strong Nino this year, and we're probably gonna be here, all winter. Just to give you an idea on how the Nino is, this is the 23, 24. That's a black line. 15, 16. That's where we have those record high yields. Okay, and we are still not such a strong Nino, but we are very close to that year. Another thing to give you an idea on how this works, around the world, you can see on the US, a Nino means that we are going to be a little, wet here in the south. That will, especially in Texas, that will really help us. That would, Texas, Oklahoma, Kansas. Okay, the same thing happened in South America, in Argentina area, where most of the wheat production is done. Okay, but the opposite thing will happen in Australia. So on Australia, when we look what happens, probably last 2 years, they have, record yields. Probably last 3 years, they have record yields and production. Okay, remember all over, when we look at the South Hemisphere, everything they are harvesting that. Okay. So we're going to see this, in the following year. But, that is expecting to be dry. So it's probably going to compensate a little bit, the highest production that we will have in South America, and, what is highest production that we're going to have in the US. When we look at Europe, Canada, those are not related with Niño, Niña, okay, patterns, the weather issues. Just to give you an idea, this is December 5, 2023, and we compare this, what happened to December 6, 2022. Here, we are not including what happened last week, that we have a lot of rainfall. Probably is going to change this a little bit. This is the drought monitor, but let's compare how we were last year. We are in a much better situation, and of course everybody who has been driving around, you can see how that wheat, they look much better than what they looked last year. Okay, US winter wheat crop condition ratings, they are higher than last year, a little lower than average, but much higher than last year so far. Okay, when we look at Texas winter wheat crop conditions, okay, they are higher than average and higher than last year this time of the year. When we look what happened with WASDE, increased a little bit exports last on 23-24, about 25 million bushels. That's the only change that they did. So ending stock decreased a little bit, okay? And average farm price is still, here, because they are considering what happened in the past, here is 730. Okay, but when we look at what long-term projections are gonna be for 24, 25, they are expecting planted acres to be a little lower. Of course, they are expecting yields to be higher, okay? Total supply also gonna be higher, domestic use about the same. We are planning to export a little more. Now that we know with these prices, we're expecting to export a little more. And still we're expecting to have ending stocks around 780 million bushels acres, still, much lower than the 1 million bushels, above that we used to have, in the past, where we have those, like $4 or $5, average farm price. So they are expecting an average farm price of $6.80. When we look about world wheat days of use on hand, basically how many, on wheat, for how many days, the stocks that we have, how many days we last. On the US, that they have been going down from 2017 to 2019. This is the first year that we are expecting that they are going up, okay? When we look at the world, those, stocks, days of use on hand, they are going down, the same thing. And when we look at world less China, thinking that everything that is in China is a net importer, so we are not going, we could not consider that is going to be available on the market to exports, okay? So worldwide stocks, are still, tightened probably the last 5 years. Even if we are producing a little more, we are also consuming more. When we look at this was done by, Mark Welt, and this is his projections on, what will be, the prices and how the prices will look like, given, what is the days of use on hand in the US. Okay, so we can compare about 2022, 2023, and we can see now that in 2024, those prices are gonna be, below $7, close to the $6.80 that we have, on the WASDE. So let's talk about what we have seen. So this is what the market is. This is from the Chicago Board of Trade. We have seen this is a July 2024 contract. Those prices after July, August, they has been going down to 645. That is now to levels that are really close to break-even prices. If we look, we compare those with the seasonal index, they are following the seasonal index. Usually, those prices are usually higher 1 year before harvest time, okay, before we plant. That's where usually they are the best. They are going down, and so far from here to harvest, most of the times that prices depends on what might happen on the weather and crop conditions, okay? There are still surprises that we can get, of course. We have seen so many black swans these last 3-4 years that I believe anything can happen, but, it usually, prices right now, if they go lower or higher, they will depend a lot on what might happen with the weather, okay? So let's talk and see how are those, I tried here to work on a little budgets and get what are the break-even price and what will be the margins, okay? And I analyze this here, and it will depend where you are, what your yield wheat, I'll show you, how that will work. But basically, our total income, with this, of course, compared to last year's, it have decreased. Variable cost, they decrease a little bit compared to last year's. Okay, we do have indirect cost, and with these prices, or a price of 630 that I put there on just wheat that we're going to harvest 100%, and we are not going to put any stockers on that. The price that we have with 630 is close to the break-even price. Okay, they're gonna lose a little bit of money with 45 bushels per acre yield. Okay, so what we got is here is a break-even price of 6.4. if we compare this with wheat, but we have dual stokers that we put them out in March, you know, in March, that total break-even price is gonna go around $6. Okay, is a little lower, if we do the 800 pounds. So that means, that we keep a little bit of those stokers, and we only harvest about 63%. And if we graze out, I was trying to calculate what is the whole cost of grazing out, and we get, the break-even grazing price for that is about 82 cents. Okay, so prices are really close to what is in the break-even price. And you know how these bases are. I don't know what you heard in every area is going to be a little bit different, but I've been hearing, some basis of, pretty close to $1. Okay, so that's $640 that we have. I mean, much lower. Okay, so when we look at wheat grain or dual stokers, and we compare those with prices on a lower, those prices with these high bases, they're gonna be probably lower than what normal break-even price is gonna be. Okay, if we compare that with wheat graze out, looks like wheat graze out might be a little better depending on what is, their grazing dollars per pound, that they're getting, what is the price that we're getting. But is this gonna be a year that is gonna be a little, for farmers is gonna be challenging, with these prices and with these bases, to be profitable with this input cost. Okay, so with that, I don't know if you'll have any questions. I'm gonna stop sharing. Okay, if you have any questions, if not, David, whenever you want, you can start your presentation.
Hey, can you see that, Pancho?
Yes,
We
Bart.
good? Fantastic. All right. You know, I'm glad John talked about mill use a little bit and kind of the implications of that for demand as USDA cuts that domestic mill use number. And the implication is really some weakening demand or some pullback in expectations. And I say that because, I think that relates to Pancho's also as we look at the wheat market, but it also is part of what's going on, I think, in the cattle market, particularly as we look at really the sharp decline in the futures market over really the last 2 months, basically, but at least 6 weeks. If we think about that, if we look at the futures, futures for fed cattle are down a good $30 per hundredweight. We went from basically $1.90 on the futures, or even more. If we, in the April contract hit $1.99 and change, almost $2 a pound. And since then, feds are down on the futures a good $30 per hundredweight. We're down even more on the feeder cattle. And this break in the futures market price and certainly lower cattle prices is really where I want to focus my comments today, and really think about some factors that are going on and why prices have pulled back like they have. And so I think here's a set of points really that why we see the futures market doing what it's doing and why we see the cash market doing what it's doing. Really, I would argue, the futures was really too high. Is that, the old irrational exuberance? Yeah, it could be. But certainly one of the big surprises this year for me as a market analyst, and I think for the rest of my colleagues that do this kind of stuff, really beef demand has been very good. Consumers really haven't seemed to have pulled back a whole lot. They continued to buy even in the face of record high retail prices, which I think led us to, with declining supplies, more and more price growth, increase in prices. And I think we got to the point when you hit kind of record high prices like that, on the futures market, I think we have a lot of traders who are just looking for a reason for the price to go down. What kicks off lower prices? And I think the first big thing for this has been that we now have more cattle on feed than we did a year ago, and that began with the cattle on feed report 2 months ago. I think for folks that don't follow that report all the time, to all of a sudden see more cattle on feed than a year ago with fewer cows, fewer calves, what the heck's going on? More cattle on feed implies more cattle slaughter, fed, steer, and heifer slaughter next year, in the first quarter of next year, than we may have expected. I think one of the other things going on has been, certainly we had feeder cattle prices that were too high relative to fed cattle prices, and certainly relative to expected fed cattle prices. So, the market bringing that back more in line with what we might see historically is part of this too. We've also got increasing cattle weights, fed cattle weights that are increasing seasonally. And so the last portion of that is really what I would call, I think, some demand worries for next year. And so with that, and really, worries may be too strong a word. I think it could be more uncertainties out there. So if we take this as sort of a set of factors as to why prices have gone down, I'm going to go through some charts and kind of hit on each one of these as I go. And I'm going to start with fed cattle prices, Southern Plains, so Texas, Oklahoma, really. Heck, we've had, if we look at the last 5-6 weeks, really declining prices. We've gone from $1.85 to $1.74 in the fed cattle market. Certainly related to that futures market decline, related to demand from meat packers for live animals that is backed off as the cutout has backed off, the wholesale market. It may also reflect, I would suggest, some future orders for beef. One of the things going on in the beef market as opposed to cattle market is we have a sharp decline in purchases for future delivery. If we go out 90 days or more for beef that's been bought today or priced in today for delivery 3 months from now, it has taken a big decline. So part of that's related to more cattle on feed. So what I'm suggesting as buyers is they're going to wait and see in the cash market and see what they have to pay later, rather than paying a high price now. The expectation is then the prices are going to come down for them. So we've got this lack of buying, which gets us into a lower cutout value. It also gets us into some lower fed cattle prices. So that 174 in fed cattle in the Southern Plains is, we're down $11. We're down $11 in the cash market. We're down $30 in the futures market. So what we've seen in the futures is a much larger decline. In fact, it also takes us from where we had a negative $70 basis of almost $10 a hundredweight to now a positive basis of over $10 a hundredweight just over this 6-week period. But fed cattle prices have come down, but they're still a heck of a lot higher than they were last year, and certainly higher than a 5-year average. So keep that 174 in mind, because if I looked at fed cattle prices in the Northern Plains, they actually dipped below $1.70. And I think at the end of last week, we were down below $1.70 in fed cattle in the 5 market average, which includes the Northern Plains and Southern Plains. That's also a big change from where we were earlier this year, where Northern Plains cattle had a $7 and $8 per hundredweight premium over fed cattle in Texas. That's flipped around. We actually have had some higher prices here than in the Northern Plains. And I would argue, I think some of that's related to relative supplies and demands for those cattle regionally going on. But I think that's something that's kind of interesting in the market that I'm not sure I've seen really picked up on yet in some of more popular press or social media stuff. So certainly we do see this decline and some changing price relationships sort of regionally. I mentioned feeder cattle prices that they have come down. If I looked at 750 pound number one feeder steers, Southern Plains, we've certainly seen a sharp decline there in the cash market, much more so than the fed cattle price, where we've gone from roughly 260 about 2 months ago to about 225, 222 last week. So a sharper price decline on the feeders and the feds has certainly gone on. And we've seen certainly that in the futures market, but a much larger break as well. But again, this overall level of prices certainly better than it was a year ago. So if I made the comment that feeders were too high relative to feds. I just took cash prices here, and I've got a feeder steer price minus a fed steer price. That spread or slide typically grows in the kind of summertime, but you can see certainly that this spread or slide was much greater than, say, a 5-year average or last year. Really a huge number, and I think that's where the pressure builds for some lower feeder cattle prices, simply because the fed cattle market doesn't really support that high of a feeder price, even with lower feed costs. And so, this break in prices certainly moves us seasonally, declining in this slide as we normally see seasonally, but a larger break than our seasonal break, really driven by that difference just gets to be, I think, too large to support. Something else that's pretty interesting in the marketplace, you look at your local auction prices. If I back off of those heavy feeders that have seen a big price decline, and I start looking at the calf market, say 500 to 600 pound steer calves or 4 to 5s, those prices over the last few weeks have actually been increasing. I mean, we took a little dip as feeder cattle did, but we've recovered quite a bit of that already, and seen higher prices for lighter weight animals. Really means that these lighter weight animals are not going to go to a feedlot or finish until well into 2024, which gives them some time to see some better fed cattle prices and get through these larger fed supplies. So I think that's a kind of an interesting phenomenon in the market that we see, where we've got heavy feeders declining and we got the lightweight animals increasing in price, really widening that slide or spread by those weights. And I think that's really just time to finishing going on. We've got a cattle on feed report that's going to come out at the end of the week. I did my pre-report estimates already. I've got placements down 5% below last year, so that would be a really large decline from October to November placements, from placements that were higher than a year ago to below a year ago. Most of the market analysts have placements, all the ones I've seen anyway so far, have placements below a year ago. I may be a little on the low side, and going into my sort of analysis of this, how did we get these placements higher than a year ago? One is we may have pulled some animals ahead to feedlots instead of wheat pasture. Pancho showed that drought monitor map, and we've seen some improvement since then. But we probably pulled some animals ahead. We probably placed a lot more heifers, and so that boosted our numbers. And we certainly have more cattle coming from Mexico. We've got more imports compared to a year ago, so that's boosted our placements too. My thinking is, if we get past those early kind of pulling cattle ahead, that implies some reduced feedlot placements in November. We'll see on Friday afternoon at 2 o'clock if that works out to be right. But so I may be a little on the low side, but I got lower placements than a year ago. That still gets us in cattle on feed. You can see in October and November, we had more cattle on feed than a year ago. That gives me more cattle on feed on December 1. I'm up almost 2%, so 1.9% over a year ago. So that still leaves us with more cattle on feed, but it's because even though placements are lower, marketings were lower still, and so on balance we get more cattle on feed, but moving back to decline to getting below a year ago, because really given cattle numbers, this more cattle on feed than a year ago is not likely very sustainable for very long, simply because we've got fewer and fewer numbers. And so I'd watch for that. But again, this idea of more cattle on feed than a year ago has really put the pressure on the futures market. I think another thing that's going on is you take a look at dressed weights. Boy, there's a heck of a seasonal pattern in weights, where weights really decline to mid-year and then start climbing. We've seen that same seasonal pattern bear out this year, but if you look at the last 2 weeks, we've been at 940 pounds dressed weight. Divide that by about, 63.5%. And you're going to see what live weights are. Live weights are pretty big. These dress weights are real big too. I didn't go back. I saw a comment from someone else that these were record large weights. I didn't go back to confirm that, but it's got to be pretty close for average dressed weights. And so we're sending fewer animals to slaughter, certainly, but they're weighing more than a year ago, and that's boosting our production a little bit, or at least offsetting some of the declining slaughter through weights. And if you're curious about heifers, we have the exact same thing going on with heifer dressed weights, that those heifers coming out of feedlots are heavier than they were a year ago as well. So that's also offsetting a little bit of slaughter. So a little more weights as well. I mentioned a falling cutout value. The trend really since mid-year has been, trending lower, but with these ups and downs that we see normally, we certainly have a declining wholesale market or cutout value. This value that's really an amalgamation of all the 7 primal cuts. This time of the year, we got the middle meats increasing, the rib, the loin are increasing with holiday buying, and the end meats, the chucks, browns, trimmings have been declining, and so really on balance is some falling wholesale values as well. They're still higher than they were a year ago, but some falling wholesale market as well. And I think this is where we start to see also some effects of a really decline in future delivery sales. People are going to wait and they're going to buy in the cash market. They're not going to buy so much ahead in anticipation of maybe some lower prices to come. So, I think that I look forward to that in the next year to see, do those start to pick up? Do we see the opportunity for some sharply higher prices in some cuts, as we're going to find out if retailers get short bought on this stuff and have to jump into the wholesale market and buy in the stock market and buy in the wholesale market in the spot market, not the stock market, the spot market, and we see some more price volatility. So that's something I'm watching for as we get into spring and really when we normally see prices go up. Let me point out beef cow slaughter a little bit. Boy, this fall slaughter for beef cows has been huge. We had a couple of weeks over 80,000 head, even greater than we did a year ago at this time. Throughout the U.S., we've moved a lot of beef cows this fall. And I think that really tells us, one is, cull cow prices have been pretty good. And so it's a case of, hey, let's grab this money while we can. But also it really tells us that, again, I think we're going to have fewer cows come January 1 than January 1 of a year ago. And so fewer cows, again, a tightening up of total supplies that really sets the stage for tighter and tighter beef production over the next several years. In that beef production comment I made, this expectation of a little more beef than we expected early in 2024 because of more cattle on feed. I think part of the thing that plays into this falling price too is we've got lower beef production this year by about 5.5%. But, 2022 was record large. And so we're talking in 2023 of having beef production that's 96.5 billion pounds. Historically, that's a very large number. Yeah, it's down from the year before, but there's plenty of beef on the market for folks. And so, I think that sort of plays into this whole case of, yeah, supplies are tighter, but they aren't as tight as maybe we were afraid they were going to be. Let me finish this beef comment with a little bit of retail beef prices. This report, the CPI, came out last week. Falling retail beef prices, both the choice and the all fresh, had declined from the month before. They're still higher than they were a year ago, but been moving lower. In fact, moving lower since the middle of the year on the choice beef side. This falling wholesale market, and we're going to find out what happens with consumer purchases, I think leaves some room for some continuing falling retail prices and declining kind of margin on the choice, the cutout to retail margin, or that retailer margin. I think there's some room for that margin to decline as we get into the coming year, particularly if folks really change their purchasing habits. So I talked a long time, but I'm going to give you 2 more slides because I did want to point out 2 lamb market slides real quick. If we look at imports, the import data came out 2 weeks ago. Lamb imports increased. You'll look at this red line. They normally increase seasonally. This is a bigger jump than that seasonal rate. Got us above a year ago. I tell you what, on the lamb side of things, that concerns me a little bit with rising imports. When we had really seen a decline through the first half of the year, we got some rising imports, and I think that's going to keep pressuring lamb prices. We've seen prices for lightweight slaughter lambs, for feeders, even some slaughter lambs to get above a year ago, finally in the second half of the year. But this increasing amount of imports, I think, is going to be a real problem that we see going forward, because it's just going to pressure that market when we could certainly use some help with some tighter foreign supplies, maybe helping our domestic prices a little bit. But one reason we see this increasing the increasing level of imports is if we look at the spread of Australian versus U.S. Leg of lamb prices. Legs are a holiday kind of item as well for many people, and we see a widening spread, meaning the Australian product in the red line is getting a bunch cheaper than our domestic U.S. price. And the wider that spread gets, the more imports we bring in. So I think this is adding a little boost to bringing in some more of those imports. And so I think that's something that's going on in that market. I think we'll see a lot more talked about in terms of lamb prices going forward. And with that, I'm going to end my show because I talked longer than usual. I'll stop sharing my screen. I think I got that done. The last thing I'll say is Merry Christmas to everybody. I guess we'll be here after the New Year together, so I hope everybody has a great holiday. You guys got any questions for me?